It began quietly. No breaking news banners. No emergency speeches. Just a handful of signatures placed behind closed doors, under fluorescent lights, far from trading floors and public scrutiny. Yet within weeks, screens across the Middle East would bleed red. Markets plunged. Fortunes evaporated. And millions of ordinary lives were pulled into a storm they never saw coming. Investors in Dubai refreshed their dashboards in disbelief. Traders in Riyadh stared at frozen numbers, unsure whether to sell or simply watch. Across Europe and Asia, analysts leaned closer to their screens, sensing that this was not a local shock but a tremor in the global financial system itself. One question echoed quietly through boardrooms and ministries alike: how did this happen so fast? At the center of the chaos was a deal few outside elite circles even knew existed. A deal shaped by geopolitics, fragile trust, and economic ambition, one that exposed how deeply interconnected global markets truly are, and how vulnerable they can become when power, secrecy, and finance collide. Could this happen in your country too? Or is this crisis uniquely tied to the Middle East's political and economic fault lines? If stories like this fascinate you, subscribe to join us as we uncover hidden global truths. And tell us, where are you watching from? Because what unfolded here didn't stay here. Tonight, we trace the quiet origins, the explosive fallout, and the lingering lessons of the secret deal that shook an entire region. Long before the headlines screamed collapse, the warning signs were almost poetic in their subtlety. In quiet government offices across the Gulf, advisors spoke in lowered voices about strategic realignments and temporary liquidity bridges. The language sounded harmless, reassuring, even. But beneath those phrases sat a growing unease, the sense that something fundamental was being rearranged. The deal itself was never announced publicly. It didn't arrive wrapped in optimism or national pride. Instead, it moved through back channels: a sovereign wealth adjustment here, a currency exposure shift there, a promise of future stability in exchange for immediate risk. To foreign observers, it looked like routine statecraft. To insiders, it felt rushed, almost desperate. Global banks were among the first to notice the irregularities. In London and Frankfurt, risk committees flagged unusual capital flows tied to Middle Eastern assets. The money was moving faster than the explanations justified. Analysts exchanged glances, a mix of curiosity and concern. Why now? And why in this direction? At home, citizens felt nothing at first. Cafes stayed full. Construction cranes still dotted the skylines. Evening news focused on diplomacy and development, not balance sheets. Yet beneath the surface, pension funds were quietly reweighted. State-backed institutions took on exposure they normally avoided. It was as if the region was betting heavily on tomorrow, while quietly mortgaging today. Then came the first whisper of doubt from abroad. Asian markets hesitated. European investors paused allocations. Not because they knew the deal, but because they sensed its shadow. Something had shifted. And the markets, famously emotional and unforgiving, were beginning to feel it. What made the deal dangerous wasn't just its secrecy, it was its timing. The global economy was already balancing on a thin wire. Interest rates were high. Liquidity was tight. Investors everywhere were allergic to uncertainty. In that environment, even a small miscalculation could echo loudly. Behind closed doors, the agreement tied regional markets more closely to external debt instruments and foreign currency exposure. It was designed to signal strength, a declaration that the Middle East could stabilize itself without outside rescue. But markets don't trade on intentions. They trade on confidence. And confidence, once questioned, unravels quickly. In New York, hedge funds quietly adjusted their positions. In Singapore, commodity traders began pricing in risk premiums they couldn't fully explain. A senior analyst at a European bank described the moment as watching a storm form on radar, faint, distant, but moving faster than expected. Still, no alarms rang publicly. Credit rating agencies remained cautious but calm. Government spokespeople reassured citizens that fundamentals were strong. Growth projections were repeated like mantras. The message was clear: there was nothing to fear. Yet internally, stress tests told a different story. If oil prices dipped, if foreign capital hesitated, if even one pillar of the deal cracked, the consequences would cascade. The system had become efficient, interconnected, and fragile. Then, quietly, one foreign institution blinked. A delayed settlement. A postponed rollover. A small move barely noticed by the public, but seismic to those watching closely. Markets thrive on momentum. And hesitation, even microscopic, can reverse it. The whispers were no longer rumors. They were signals. And once the first signal is read the wrong way, markets don't wait for clarification. They react. The collapse did not arrive as a single moment. It unfolded in waves, each one faster, sharper, more unforgiving than the last. It began on an ordinary trading morning, when regional indexes opened slightly down. Nothing dramatic. Nothing historic. Just a gentle dip that seasoned traders had seen 100 times before. Then the selling accelerated. By midday, trading floors across the Middle East felt different. Phones rang without pause. Orders stacked up faster than systems could process them. On giant LED screens, red arrows multiplied not in panic yet, but in warning. This was no longer a correction. It was a question being asked by the market itself. Across Europe, investors watched in disbelief as losses deepened hour by hour. Asian markets, opening later, reacted instantly. Futures dropped before the first bell rang. The deal, still officially unnamed, was now being priced in by everyone who sensed risk but lacked clarity. And in financial markets, uncertainty is often more dangerous than bad news. Government funds attempted stabilization. Strategic buying slowed the fall, briefly. For a moment, optimism flickered. Commentators spoke of resilience, of long-term fundamentals. But beneath that calm veneer, capital was already fleeing. International investors were pulling back, not because they understood the full story but because they didn't. Then came the trigger no one wanted to acknowledge. A sharp currency movement. A sudden repricing of sovereign risk. Algorithms reacted in milliseconds, amplifying fear faster than human judgment could intervene. Liquidity vanished. Bid-ask spreads widened. The market, once confident, was now defensive. In cities built on ambition and growth, silence replaced confidence. Traders leaned back, hands on their heads. Officials stared at dashboards updating faster than explanations could form. The secret deal had crossed an invisible line. And the world was watching what would happen next. By the second day, the story was no longer regional. It was global. Financial newsrooms from Tokyo to Toronto rewrote their morning scripts. What had begun as a localized market tremor was now framed as a stress test for emerging market confidence everywhere. If a region this capitalized, this strategically important, could unravel so quickly, what did that say about the rest of the world? Foreign reactions hardened. European pension funds froze exposure. Asian sovereign investors delayed commitments. In Washington, policymakers held closed-door briefings, not out of panic, but calculation. Energy markets wobbled. Insurance costs spiked. Even currencies far removed from the Middle East felt the pressure, pulled by invisible threads of global finance. Inside the region, the emotional cost became impossible to ignore. Small investors watched savings shrink in real time. Entrepreneurs postponed expansions. Construction projects slowed, then stalled. Confidence, once the region's greatest asset, was leaking away, hour by hour. Officials responded with statements meant to calm, not explain. Markets listened politely, then sold anyway. Because what frightened investors was not the losses themselves, it was the realization that the deal anchoring stability had limits no one fully understood. Behind the scenes, emergency negotiations unfolded. Lines were opened to international partners. Quiet assurances were sought. But leverage had shifted. Those who once needed access now dictated terms. And the cost of restoring trust rose with every passing tick on the screen. Analysts would later say the meltdown wasn't caused by a single decision, but by a chain of assumptions, each reasonable on its own, catastrophic together. A reminder that modern markets don't collapse from explosions. They collapse from silence, misread signals, and the moment confidence breaks. As trading halted and volatility surged, one question lingered across continents: was this the end of the crisis or merely its midpoint? When the sales finally slowed, it didn't feel like relief. It felt like exhaustion. Markets stabilized, but confidence did not return with them. In the days that followed, the region moved through a strange quiet, a pause filled with reflection, second-guessing, and unspoken regret. Numbers stopped falling, yet the damage had already settled into balance sheets, public trust, and political memory. Across the Middle East, conversations changed. In boardrooms, executives spoke less about expansion and more about resilience. In homes, families discussed risk in ways they never had before. The crisis had transformed abstract financial systems into something personal. Abroad, reactions softened into analysis. European economists debated whether transparency could have altered the outcome. Asian investors questioned how much trust they were willing to place in opaque state-led deals. In academic circles, the meltdown became a case study, not of failure alone, but of modern fragility. A world where speed outpaces understanding, and complexity hides danger in plain sight. What lingered most was the realization that the deal had not been irrational. It had been logical, even elegant on paper. But global finance is not governed by logic alone. It is shaped by psychology, narrative, and perception. And once the story shifted from strength to doubt, recovery became exponentially harder. The markets had spoken. Not with anger, but with memory. They would not forget quickly. In the end, the secret deal did not just trigger a market meltdown. It exposed a truth many systems prefer to ignore: stability built on silence is always temporary. The Middle East recovered, slowly and unevenly. Some sectors rebounded. Others never did. Trust returned, but selectively, cautiously, at a higher price. International partners demanded clearer terms. Domestic institutions learned that confidence cannot be commanded, it must be earned, continuously. For the global audience watching from afar, the lesson was uncomfortable. This was not a story of reckless speculation or sudden disaster. It was a story of interconnectedness, of how decisions made quietly in one region can ripple across continents, affecting lives far removed from the signing table. In a world bound together by capital, information, and belief, the line between local choice and global consequence has all but disappeared. What feels contained rarely is. What seems stable may only be waiting for its first question. And perhaps that is the quiet truth left behind by the collapse. Markets do not fear risk. They fear the unknown. Because once trust breaks even briefly, the cost of rebuilding it is measured not just in money, but in time, faith, and human confidence. In the end, this was never just a story about collapsing charts or vanished billions. It was a reminder of how fragile trust becomes when power operates in silence. From trading floors in the Middle East to policy rooms in Europe and Asia, the message echoed quietly but clearly: transparency is no longer optional, it is the backbone of modern stability. In a world bound together by capital, confidence, and belief, no decision is truly local. Because when trust fractures in one place, the shock travels everywhere. And rebuilding it always takes longer than anyone expects.